Okay, good afternoon, folks. Nice to have you all here. People are starting to stream in, but I think to be courteous to the people who've come in on time, we'll get started. We've hosted a series called Investing Made Simple for global investing, and this is the third part of that series. We've broken it down into some quite specific chunks. The first two really focused on what you can invest in and how much money you should expect to make offshore. And we've completed those. We had a session probably 6 weeks ago covering the different asset classes offshore and what's been experienced with them. The second one, we talked about individual equities. We had about 10 of our fund managers and analysts go through specific shares. We're now taking a bit of a step back into something a lot more technical. So for those of you who are not seriously thinking about investing offshore, this will become quite complex. But the issues are complex, and our guys, together with financial advisors out there, can certainly help your cause and help you get invested offshore. So we've got 3 of our experts talking about the mechanics of offshore investing across different topics. And if you do want to go back and look at the previous 2 parts of the webinar, you can find them both on our website under latest research and videos. And remember that in about 2 weeks' time, we're going to be having the 4th of the 4-part series, which is about financial immigration, where we've got one of our experts here to talk about it. So let's get into. I'm going to try and just keep mine to about 10 minutes. I think for people who've logged on, they're wanting to know about the mechanics of offshore investing. So I'm just going to give you a brief overview of where we sit. Just a reminder for those who aren't familiar with Anchor Capital. We're a global investment business. We've been going about 9 years. We look after local and global investments. But from the start, we've, in fact, one of the model portfolios we first started nine odd years ago was a high street equity portfolio, which 9 years later has got a great track record. We invest about $5.4 billion, which changes by the day, depending on the currency, to about 85 billion rand. And we've got about 30 investment professionals in our business. So just to give people a perspective of the long term and why we think you should invest offshore, and particularly if you're a high net worth individual, to diversify your holdings. What should you expect offshore? In the growth space, global equities over time have given an 8 to 10% return in dollars. And importantly, that comes with a fair amount of predictability over any reasonable time period. We've really been spoilt over the last 5 years, where that number has been closer to kind of 13 to 15%. And there's every possibility that things slow down in the short term. But importantly, if you're taking your money offshore, you're doing it for the long term. We're still comfortable. We can put together portfolios of shares that we're happy to own in a 5-year view. Global GDP growth over the next 5 years, we think will run at an average of about 4% per annum. And that's an important number. From a local equity perspective, returns can be higher than global. In fact, over the course of the last year, you've got a better return out of the SA market than offshore market in rands and dollars. But it does come with much higher risk. So before the last 12 months, there were a number of years of flat returns from South Africa. And you can see it's a very different risk-return profile. And if you're buying into the SA markets, you're buying predominantly into resources, NASPAS, and then South Africa Incorporated, where the South African GDP growth is likely to average around 1 to 1.5% over the next 4 years. So you certainly do want to be exposed to the growth sectors of the world. The rand is stronger than it was 6 years ago. So that hasn't given you the benefit that everybody expects. I think most people are rand bears over the long term. But after having been flat for the last 5 or 6 years, there's every chance that the rand continues on its weakening path, as it always has over the last 20 or 30 years. From an economic point of view, the rand should differentiate by the differential in inflation rates. And one of the reasons the rand hasn't been too weak is our inflation's actually been quite low, and a country like the US has been quite high. But that'll even out over time. So you've got a lot more risk. But probably more importantly than just local or global, and everybody's fixated about the right currency to take it out with, is the investment opportunities you get offshore. There are literally 100 times the opportunities that we've got in South Africa. In SA, there's really 60 investable shares. And when we scan shares offshore, we start with a base of about 6,000. So it really is 100 times the opportunity. And I think this is borne out by the slide I've got here. These are the 10 best performing shares in South Africa over the last 10 years, and then the 10 best performing shares in the US. So it's important to note that a smart investor can make money in the South African market, and there's some great returns from some great businesses there. But if you flip over to the right-hand side, many more shares that have delivered even higher returns. So the opportunity set for the smart investor certainly does lie offshore. This is the important backdrop from a global perspective. After a 3% drop in GDP last year, we're looking for about 6% next year and still around the 3 to 4% level for the following 2 years. So we expect there to still be some pretty strong global GDP growth as the world recovers and the benefits of stimulus continue to flow through. This is really the story from a technical basis as to why the US market and the MSCI world has continued to do very well, despite having recovered very nicely last year and given a 16% return. This is the earnings on the S&P. So this is the top 500 American companies. And if you go back to 2019, that was about 150 cents a share on the S&P. So you can use a PE multiple on this. So the 150, if you times by 20, would give you an S&P level of about 3,000. Remember, we're trading at the moment at about 4,400. So that went down to about 120 cents in 2020. And at the bottom, people were questioning whether earnings in 2021 could recover to 2019 levels. Not only have they recovered, but they're going to land up being about 15% higher than 2019. And that's because of the stimulus that's been thrown at the market. And money is about as cheap as it's been in the US for the last 3,000 years. It sounds like a bit of a nonsensical statement, but it's a chart I picked up yesterday from Merrill Lynch. I'm not sure how reliable the numbers are going back 3,000 years, but suffice it to say that people are incentivized to take equity risk and to finance risk with cheap money. And we don't think that's going to change anytime soon. So that's what's happened. If you look back to January 2020, the S&P was at about 3,300. It's now sitting at 4,200. We do think the market is likely to have some sort of correction in the shorter term. But for people who are making long-term investments, we're still confident about putting money into the market. The Rand is the next important component. And you can see the Rand gradually depreciates over time, and we fully expect it to. And of course, with the tail risk, with the kind of South Africa-specific risk that we've got, that can see it spike at any point in time. So we'd be happy to back this curve. You can see over the course of the last 5 or 6 years, the Rand's been flat with quite a bit of volatility. But our forecast for the Rand is 14.45, 12 months out, and continuing to weaken from there. So the big issues in global investing is, has the market run too much? I think very importantly, having been through a few bull markets, when the market's in an upward trend, we don't fight it. We remain positive in equities. We've kept clients' funds invested, perhaps putting a little bit into cash. But you lose more from not letting these things run than getting out at kind of halfway up. So we're still positive, but we think the risks of the market correcting or having a bit of a pullback, even if it's just for the reason that it's gone up 15 months without a 5% pullback. The big questions are for us are threefold. Has the market run too much? Does the pandemic have Act 2? We're quite concerned with the extent to which the Delta variant is seeing cases around the world pick up. For the moment, the US is really the poster child for saying we vaccinated most of the people we're going to, and let's see if we can disconnect the virus by the vaccine from serious hospitalizations and deaths. And that certainly is the case at the moment, and that's what we're watching most closely. Is China going to cause economic destruction? We had a webinar on Friday with a tech analyst out of Shanghai. China certainly are looking more aggressive. It saw the Chinese tech shares come off 10 or 20%. If anybody's particularly interested in this topic, we've written quite a bit on it over the course of the last week or two. And there's a great webinar that we hosted on Friday that I think was very well received. And we're very happy to discuss it with you. Has civil unrest impaired South Africa? I think it certainly heightened the risks. and reminds one that you should be diversified across asset classes, geographies, and specific shares. So our formula over time is we buy shares in companies we back with high returns, good growth, at reasonable prices that we're happy to own through market cycles. It worked in 2020, it's working in 2021, but it's our job to keep an eye on all of that. So we still remain in an equity world, and we talked about the global bull market. The developed world is growing apace. The rand is largely driven by commodities. So as long as they're strong, you're likely to see a fairly strong rand. But commodity markets don't last forever. We think things like iron ore will come off, and have, in fact, have come off a bit in the last week or two. Platinum, we're a bit more bullish on longer term. So the global good news is, if anything, at risk of peaking. But in terms of externalizing money, we wouldn't get fixated with trying to time the currency and the markets. If you're making offshore investment decisions that they're generational, they're typically, and we have very few guys who take money offshore that then bring it back. So what do we do as South Africans? As I showed you, there's still opportunities in South Africa. We're still very active in the SA stock market to take advantage of those. We'd avoid SA physical property. If you've got rental properties and factories and the like, we tend to want to keep that liquid and keep it offshore. You want to protect from the rand. We like the phrase, live in the sun, invest in the shade. So take the benefits of South Africa, but make sure you cover it from a global perspective and spread your bets. At the moment, the impetus is strong, but picking shares is key. I think I'm going to leave mine at that. I've used up my 10 minutes or so. We've got 3 more speakers, all talking about different aspects of the mechanics of offshore investing. Next up is Darryl Hannington. And Darryl is going to talk about the mechanics of getting your money offshore. And then Haiden and Brendan Gace will talk about what to do with it when it's there. So Darryl is our head of portfolio management. He's been with us since the start of the business. He's helped many, many high net worth individuals and financial advisors and their clients get money offshore. And there's nobody better to educate you about not only the rules, but the practical implication of doing these things. So over to you, Darryl.
Thanks, Pete, and good afternoon, everybody. As Pete mentioned, we've spoken about good shares to buy. We've spoken about other assets, but invariably, what I'm going to try and unpack today is exactly how do we go about doing that. Now, there's quite a common misperception amongst first-time investors offshore that getting money into hard currency and invariably making an offshore investment is a difficult thing to do. Now, this is actually not the case at all. And there are various ways that different investors are able to firstly buy currency offshore and then make an investment. What does that all mean, though? Well, it's as simple as opening an offshore custodian account at the end of the day. An offshore custodian account in our lives, either via Perisec, which is in Guernsey, or the Capital International Group, which is in the Isle of Man, will allow an investor via one of 3 ways to transfer money directly from a South African bank account or via an offshore bank account into this custody account. Important to consider, though, that the ultimate custodian of all of our clients' assets on those 2 custodian portfolios is essentially Bank of New York Mellon for Pershing and for Perisec, and Pershing for the Capital International Group. So in the all fall down scenario, Anchor doesn't exist tomorrow. Please goodness, that's not the case. Perisec doesn't either. At the end of the day, you hold shares at one of those 2 custodial accounts. So what are the different ways of getting money overseas? Well, let's start with the single discretionary allowance. An adult South African is allowed to take up to 1 million rand every single year without any approval through their authorized financial dealer. Now, important to consider here that your single discretionary allowance, which is on the next slide, please, Pete, will include things like your travel expenses, as well as any shopping that you do while you're traveling or online shopping that you do in any given year. So importantly here, there isn't a need for any approval. It's as simple as going to your authorized dealer, provided you haven't used any of your 1 million rand limit. They will convert your rands to dollars, pounds or euros in a day with no approval. Now, what happens if we want to take more than our million rand, a single discretionary allowance? Well, also a relatively simple process, but it does require approval from SARS. we or our clients are able to apply to SARS for a foreign investment allowance or tax clearance certificate for up to 10 million rand per adult per year. Importantly here, this is not a calendar year. On approval of the tax clearance certificate, you have 12 months to use it. Now, in our experience, this process has been quite an arduous process in the past. It's involved quite a few trips to SARS for either our clients or their tax practitioners, but this was all moved online about 24 months ago. Recently, you generally are looking at somewhere between 6 to 8 weeks from application to approval, provided your tax affairs are in order, which can be quite a nerve-wracking 6 to 8 weeks, right? Because when we want to take money into the offshore markets, often it's exchange rate and currency dependent. But there are various ways to essentially lock in an exchange rate. And I encourage you to speak to your financial advisor while you are waiting for that tax clearance. The importance of using a good tax practitioner here cannot be overstated, someone who knows the online process well and has done it a few times. In our experience, more recently, we've had cases where clients have been able to get their full tax clearance approval in about 2 to 3, sometimes 4 weeks. So you can definitely shorten that 4 to 6 week anticipated SARS timeframe with the right tax practitioner. So now I've talked a little bit about, individuals who've been able to take money out via either single discretionary or financial tax clearance approval. What happens though for an individual or for a company, a local company or a trust? What are the ways that an entity in South Africa is able to invest offshore? Because there's certain regulations that prohibits the South African trust or a South African company, as an example, achieving the same tax clearance that an individual is able to. Well, this is called asset swap. It's a very simple process. At the end of the day, the South African investor transfers money onto an asset swap provider's balance sheet. That asset swap provider will, as the name suggests, swap those rands for hard currency and offshore investments will be made. There are a couple of key nuances or considerations here and why asset swap is different to FIA or single discretionary allowance. Well, asset swap, although the investments are made into offshore assets, are still viewed in the eyes of the South African, of the SARB, as local assets. Importantly there, also in the eyes of SARS, they are viewed as local assets as well, which means that there are various tax implications for the way that capital gains especially are treated. Again, I suggest that you speak to your financial advisor just to kind of pick the eyeballs out of what these differences are. So who can invest and how? We've spoken about 3 main reasons or ways of doing it. As I mentioned, South African adults are able to invest via single discretionary allowance without approval, via FIA with approval, and in fact, a South African adult is also able to invest via asset swap versus a local entity, trusts, companies, and the like, which most times are not going to get approval to invest directly offshore, so they would need to go the asset swap route. So we've talked about the approval process, but what about actually buying the currency on my last slide piece, Pete? And so let's just talk about that because it's an important consideration here. And there's a lot of rands and cents that often gets left on the table by our clients who are none the wiser. The bottom line is that foreign currency is a commoditized product. And in a commoditized product, in our opinion, best price wins. So don't just assume that your foreign exchange provider, whether it's your bank or anyone else, is going to give you the best price when it comes to the forex that you're buying. Again, we would encourage our clients and potential clients to really shop around when it comes to forex spreads and the like, and we do help our clients internally to do that over time. Thank you very much. I'll hand over.
Thank you very much, Darryl. Next up is Haiden, who's really an expert in the offshore space. Di's been with the Anchor Group for 6 or 7 years. We purchased a business that she was one of the managing partners of called RCI, where for decades before that, Di's looked after clients and looked after their trust affairs and the like. So Di, we look forward to hearing your expertise.
Thank you, Pete, and good afternoon, everybody. Thank you so much for joining us. As you can see, what we have to consider now that Darryl's told you exactly how to get your money offshore is what do we need to think about? And this is just an index of what I'm going to talk about in the next few slides. We've got the quantum of money that you're going to send offshore. What are you going to invest it in? Which jurisdiction are you going to put it in? Are you going to need a structure in which to invest? We'll touch very briefly on looping structures at a high-level view. And what is the effect of all this on your estate? So next slide, please, Pete. So what we have to look at first is what is the amount of money that you're going to send offshore, bearing in mind that you can either send your discretionary allowance, your 10 million rand plus your discretionary allowance, and several of you from one family can send it. So the quantum of funds determines a lot of what happens with respect to where the money is, does it need a structure, etc. And you need to decide, first of all, of your assets, how much do you want to invest offshore and how quickly are you going to diversify your asset base and get it offshore? And depending on what you do there, we will then look at it and decide whether you do need to consider all the next few slides that I'm going to go through. Please bear in mind, it's always very case specific. All your aspirations are different, and there is no one size fits all, and that's what we have to think about when we're looking after your wealth. So if we could move on, thank you. First thing is, what do you want to invest in? And here we've got a list of a diverse range of products, and they're not exclusive. There are a lot of other things you may want to invest in, but listed there are the normal ones that I'm sure you're all familiar with, and we can assist you with investing in any of those. Your financial advisor would just need to guide you depending on what your risk profile is, where you want to be, etc. Thanks, Pete. So once you've decided what you want to invest in, where are you going to invest? And you can see we've circled all sorts of parts of the globe there. Some of them are developed markets, some of them are emerging markets. And you would need to decide with your financial advisor where you want to be invested. And that's purely an investment decision. But that has an effect on all sorts of things, including CITES. I'm sure you've all heard of the word CITES, bandied around to a large extent by in terms of US tax. And what CITES is, just to define it for you, it's the place to which property belongs for legal and tax purposes. About 4 years ago, a certain suite of legislation was introduced called Common Reporting Standards. And it's legislation that was basically signed by all jurisdictions globally. And what it enables all the tax authorities within all the jurisdictions to do is to share information. So if the South African tax authorities want to know about assets you may have invested in the US, they can easily source the information. What that means is that everybody's become much more aware of what the tax jurisdictions are globally and how they affect where you invest. What's also important when you're looking at that, for instance, in the US, I'm sure most of you know that if you die, estate duty on listed shares in the US can be as much as 40%, which is basically double our rate here. But it doesn't apply if you hold cash in the US. In the UK, CITES applies to cash and to shares on your death. So it's very important to understand the implications of where you're investing, and double tax agreements also come into play here, and we mustn't forget that. Thanks very much, Pete. So the structure. So now you may have transferred 1 million rand, you may have transferred 30 million rand or more, and you've now decided what you want to invest in and where you want to invest. So based on those decisions, do you need a structure other than holding assets in your own name? And which one's appropriate for you in particular, and do you actually need one? So there we've listed a number of the structures that you can invest in offshore. So what happens is, own name is obviously you. The asset is just held by you. But the others basically wrap the investment and it sits within a structure. So just running through them very quickly, there's the wrapper, which is your endowment, basically that wraps the asset. You have a trust, you can invest the funds in an offshore trust. You can use a pension plan. You can have a company that sits under the trust or where you're the shareholder. And in addition, there is a family foundation. Each of those has advantages and disadvantages. We're familiar with all of them and can give you some guidance as to how they would affect you. For instance, a wrapper does have an effect on the tax. It mitigates the tax effect from a South African point of view, but you still have to pay a state duty. In a trust, offshore trust, the assets are not taxed, but it has tax implications for beneficiaries depending on where you are resident. But there is no state duty, and so on and so forth. In terms of companies, we will touch on looping structures and look at that. And a lot of these are what are known as estate duty blockers and can be used effectively from that point of view. But one must always remember, if you're in a structure, there are extra costs. And you need to understand them, and it's a toss-up between, is it worth the extra cost to have the benefit of the structure? I think that's about it on that, Pete. Thank you. So then, you've now decided that you do need a structure because you've got, for instance, 50 million rand that might be sitting offshore, and you'd rather have it held not in your own name. So then you've got to look, and this is not the same as where you invest. We had the slide on investments with the destinations. Now we've got a slide on structures and where you want the structure to be held. So you will see 3 little circles on the slide, mostly in the ocean. But that is because those are particular jurisdictions that are friendly for these sort of structures. And you've marked that it's not Cuba, by the way, just there below the US. It's actually the British Virgin Islands is a good structure, is a good place to have a structure in. And then you've got the Channel Islands just up there above the UK, which is circled. And then on the right-hand side, bottom side, you've got Mauritius. And we have an office in Mauritius that has been hugely beneficial for clients to use in order to diversify their asset base. But one can use any of those structures, and there are obviously others, and we do use them quite extensively. Thanks, Pete. So then to move on to, I mentioned that you could hold assets in a company. And I'm sure that you're all aware, or a number of you will be aware, of the fact that in January this year, the Reserve Bank here loosened exchange control on looping structures. So basically what you were not allowed to do as a South African is hold funds offshore or in an entity where you were a connected person and reinvest back into South Africa. As you can see there in the middle of the chart, it says this ownership was not allowed. So up until now, in terms of holding companies in South Africa, it's often held by a trust or in your own name. And that structure was completely separate to the offshore structure. Now, with the relaxation of the looping transaction legislation by the Reserve Bank, that's now changed. Can we move on, please, Pete? And here you can see that, no, the one above. Thank you. Here you can see the same graphics with your individual in the middle, your local trust, and your offshore trust on the right. And that offshore trust is now allowed to hold assets in South Africa. So instead of those arrows pointing to the local holding company not being allowed to be held offshore. You can now see that you can hold it from offshore. And there are advantages to that. One of them being that it might be possible to reduce the dividends withholding tax that's due on the flow of dividends from your South African company. However, it's complicated. This really only applies to corporate structures. It's difficult for individuals to take advantage of it unless you're holding South African companies. And one has to be aware of where the holding company and the offshore trust are, because there does need to be a double taxation treaty in place with South Africa. So that's very high level. It gets a lot more complicated than that. We are in the process of doing a couple of them at the moment. It's also new that most of them are at the stage where they are seeking approval with the Reserve Bank and SARS. Not to need approval, that's the wrong word to use, but they do have to be reported. So that's a very important change to the legislation. I think what I'd like to point out here is that in 1997, when one was allowed to send funds offshore for the first time legally, the amount was 250,000 Rand. And you can see now it's 10 million Rand for an individual, and there is more and more legislation coming through relaxing exchange controls. So I don't think we need to be too alarmed that exchange control is going to tighten. It's certainly not the way things have gone for the last 20 years. So if we can just move on to the next slide, which is one of my last ones, and maybe the most important, is all of these considerations we've been talking about up until here affect your estate. So what is your estate? Your estate is everything you own, whether it's here or offshore. If you're South African tax residents, your worldwide assets that are subject to tax in South Africa, doesn't matter whether they're here or offshore. So there's no tax advantage to being invested offshore. It's ready to diversify your asset base. There are obviously tax implications, as I pointed out, to where you invest offshore. There are CITES issues in a number of the countries. Probably the most prohibitive is the US, but the UK is not great either. France has its own set of rules on money that's invested there. Europe altogether. You need to understand how each of those jurisdictions works in order to quantify what the issue might be for you. So then another thing that one will come across, and I'm sure you have over the years, is this word probate. And what happens in places like the UK is probate is basically the same as winding up an estate in South Africa. Probate runs there as opposed to here calling it winding up an estate. It's very important to understand where your assets are. For instance, you might decide you want Portuguese residency and you're going to go and buy a property in Portugal. That has tax consequences. It also has consequences for your estate and your will. So you might think that, well, you've left all your assets in your South African estate, in your estate, whether it's here or offshore, because you've got a South African will. You've left it all to your heirs as you see fit. If you hold a property in Portugal, you may find that it's subject to what is known as forced heirship, which is what applies to a lot of European countries. And what you think is going to happen in your will is not actually what's going to happen when you die. So it's very important to understand whether you need a local and an offshore will or just a local will. Your local will always cover your worldwide assets if it does not say that it's excluding your offshore assets and only applies to South Africa. But that comes with its own set of complications. So please, if you have decided to diversify your asset base, and it is all over the world, it would be a good idea to chat to us. We do have expertise in this area and can certainly assist you in knowing what is good for you and what is not. Obviously, all of this affects your family. And what we like to, or what is important to understand is, where is your family? Are they all here in South Africa? Have a whole lot of them moved overseas, which is what often happens, particularly to Australia, the UK, not so much the US, but that's becoming more and more popular. And it's important to understand what the implications are of all of that for your estate, because it does have implications. And especially if you're investing offshore. And then the last thing I'd just like to point out is, if you are thinking of emigrating, please just consider your options. There are many, but each one has its own set of implications. So on emigrating, you might have funds offshore already. You're still going to pay an exit tax when you leave this country to go and live somewhere else when you emigrate. Very often we find that SA tax residency is not actually all that bad. And if you're going to go to a place like Spain, maybe you want to consider still being resident here, because the tax regime there is fairly onerous. So, Pete, if we can just move on to the next slide. So my last comment is, if you are going to go, please think before you leave, for all the reasons I've mentioned up above. And you, in terms of having assets offshore, there's a huge world out there. We do need to look at the options, and we're very happy to do it with you. We can do that with you. So please let us know, and we can then decide together where it's best to invest, what jurisdiction you need to be in, do you need a structure, etc., etc. Thanks very much, Pete. Back to you.
Great. Thank you very much, Di. For those of you who missed the beginning, just to quickly refresh, this is part 4. This is part 3 of a 4-part offshore series. The first one talked about what you can invest in offshore, the different asset classes, prospective returns. The second one first focused on specific offshore equities, and you saw some of our analysts and fund managers get very excited about the opportunities out there. And there's a lot of fast-growing companies out there at reasonable valuations. This presentation and webinar focuses on the mechanics of offshore investing. And in a few weeks' time, we've got one specifically on financial immigration. The slides from this presentation and the presentation itself will be sent out to everybody who is watching, and we'll contact your financial advisor or one of the anchor guys if you'd like a copy of the slides. So the last one up is Brendan Gace. Brendan is our head of private clients. Once again, he spent decades in advising people on local and offshore investment. And after Brendan, we'll have a question and answer session. So please post your questions on the Q&A. It'll be at the bottom of your screen there. I think some of the people who've asked questions, hopefully during the course of the webinar, we're addressing those. But we'll certainly have a panel discussion at the end looking through all of those. So the key decisions to get going, Brendan.
Good afternoon, everybody. Thank you very much for taking the time to come and, sort of hear us talk about some of the, the observations that we see out there in real life, and trying to help you today with some sort of guidance in respect of how do you move forward when you look at and you see, there's so much talk, there's so much. So many words used, etc. It does all start getting very, very confusing, which route to go, etc. And there are certain observations that we make, or that we see people doing, and it sort of clouds their judgment a bit. They can get a bit of analysis paralysis in some respects, and it stops them from, moving forward. There are many people who invested way back, dot-com bubble, pre the old voluntary disclosure programs or tax amnesties, and many people had quite bad experiences in, at various times about investing offshore. I think, that, many of those were, due to a very limited product range and solution set, which has greatly expanded in the past sort of decade. So I think the optionality for everybody is a lot better. One of the first areas that we observe people making, clouding their judgment, I think, is the tax deferred principle, which is, tax saved is better for you. Delay paying tax as long as you legitimately are able to. And, those are sound principles. It's, but at some point in time, one's got to change strategy and start thinking about a decision. Now, South African stock market has served people very well. As Peter alluded to, there's a much greater universe out there and many more great, exciting companies to choose from. And people's families are spread far and wide nowadays. So having everything invested in South Africa is becoming a bit limiting. So, the idea of tax deferred needs to be questioned as a principle. Peter, thank you. Right, the first sort of, in that regard, I mean, one of the key decisions that people have to make is when you want to take a basket of assets, whatever, invariably it's tied up in some investment. And do you trigger capital gains tax on your local assets to invest offshore? And how would you weigh up? And once again, there's a lot of noise out there. Will be advisors sort of trying to direct you to certain places. There's your own sort of financial biases that are flashing warning signals, etc. But on this particular one, I think there are 3 or 4 factors. Consider key factors to consider: your future returns in South Africa versus your future returns offshore, alongside currency depreciation. Which one will come out tops? That is the first one. You've got to, I think, essentially believe that currency depreciation, for many of us, the currency's been depreciating, our entire lives, and will that continue? Certain indications are we'll have periods of strong currencies, but the long-term trend will continue. So you've got to believe that, and then you weigh up returns. First world returns are not going to be as exciting invariably as emerging market returns, but when you add the currency depreciation, are you better off? The next key factor is the horrible one. Actually, if you pull the trigger and you've got to pay tax to SARS. Now, in the current investment environment, the South African economic environment, that tends to really cloud people's judgment. There's such a distaste for paying tax, across unnecessarily. And but hopefully my next example will sort of give you some food for thought in that regard. The other one is diversification. You do have South African investments, and you may well have diversified South African investments in a typical balanced fund, which is 70-80%. Your pension fund would be Regulation 28 compliant, whatever the case might be, and that gives you a degree of diversification. But here you're looking to have a much greater diversification and in hard rands as opposed to asset swap investments. So those we think are the key 3 things. If we take the first example now as an illustrative example, paying capital gains. So if you've got a current structure, and I'll just talk you through the thinking, and how, I've looked at it over the years when trying to help people. The first little block of numbers there, we would have a person who's got a base cost. He bought an investment for 5 million rand. Its current value is now 10 million. So he's at a capital gain of 100%, being 5 million rand, and his capital gains tax rate, if he pulled the trigger right now, basic CGT calculation would mean he pays 900,000 rand in tax. And that's the allergic reaction test. Are you even prepared to do that? It leaves you a net value. So if you then compare current structure, let's say you left your money in South Africa and you got a certain return, or you took your balance of money, your 9.1 million rand, and reinvested it, sent it offshore, and now you're starting off 9 million plays 10 million local. What additional return, and I just used over a 5-year period, how much extra return do you need to get over that 5-year period to sort of get you back on par where you were for having paid and defied or ignored the deferred tax principle? And you can see that the difference in total return would be annualized return of 10 on your local investment versus 10.85%. So 0.85% would be the material difference. When you bring it down to a number like that, and you go back to my first statement where you compare local return versus offshore return plus currency depreciation, I would think that the universe of opportunities does provide a great chance that you will get back that 0.85% that you've lost out on by paying tax upfront. And I think you could do well beyond that, because you've now got a much broader universe of shares to choose from. Thank you, Peter. So the second example, go back one. Where are you going? Okay, avoiding citus tax. So the second example that pops up, and Di made reference to citus tax or the use of wrappers. This is just one particular structure, and every single one of these things has to be taken, or solutions has to be given some thought. There's the price element, there's a product element, does it suit you, and there's a service element. Is it suitable? Do you get the right information being fed back to you, and decent service from these offshore providers? And you also want that comfort of decent regulation, and is it protected? In your assets, are they protected by being legislated or regulated properly? There are many asset structures offshore, so one's got to be quite careful in that regard. But the idea of avoiding citus tax, so using almost that same example where somebody had your current structure, and let's say this was money already offshore, and you had it in the wrong structure. So let's say you had 5 million, current value being 10 million, and 10 years from now, using a 10% growth, you would end up with a value of 23 million rand. The capital gain at that point in time would, if you then sort of passed on, would be 18 odd million. You'd have capital gains tax at 3.3 million, and then you're coming down to your estate duty calculation on your estate, another 4 million rand being 20% of the value. And if you had citus tax, just using the US example or the UK example, let's round figures, call it 40%, and then you take off executive fees, your net value would be 11.3 million rand, and that's what would be passed on to your kids in essence. And whereas if you just sort of made that move and across to a wrapper is a change of ownership in terms of it does become a life, there is a life assurance company behind it, so your base cost, you would trigger the capital gains. You now got paid that 900,000 rand or current value. If that then grew at the same 10% going forward, 10 years from now, you've got 21 million. Your capital gains tax would be slightly lower second time round because your base cost was a bit higher. And inside the wrapper, you have a 12% CGT rate, as an example, and you would then be left going down to estate duty, have a slightly lower, because your gross value is a little bit lower. There'd be no citus tax because you're in a structure that is protected from there, and there's no executive fees on that particular sort of endowment structure, leaving you a net value of 15.9 million rand. And that gives a return enhancement over the 10-year period after paying the tax of 4.65 million or 41%. There are wrapper costs along the way, and that would be, roughly, I think, 0.35%. Some are can be quite a bit more expensive, but you've got to shop around. And so that then leaves you a choice. Do you stay where you are ongoing, or do you pick up the wrapper, the wrapper costs and make that change, pay some CGT along the way? Our sort of observation at looking at this assessment, invariably it does work out to be, quite advantageous to clean up your affairs. You don't want to be paying those three lots of tax, CGT, estate duty, and citus tax, if you get caught on the wrong side of an investment profile, or your family certainly doesn't want to. So, and you bring this out to, take it over a 20 or 30 year period, it gets a hell of a lot bigger. So the structures can all be very helpful. There are many structures that alluded to some of them earlier on. I think the ones, well, first off is please, guys, try and keep things legitimate. Our observations with Reserve Bank and SARS, with common reporting standards, people with, that went into some of those structures with the Panama Papers that we heard about in the media a while back, the cryptocurrencies, if you don't keep that legitimate in terms of your tax returns, these things are going to get, you are going to get caught up in a net. So please don't look to, because many people have this idea, I want to send money offshore and I don't want SARS to know about it. That, SARS knows should know about everything. And certainly the US IRS is endeavoring to know about everything about everybody. So, just suggestion is keep it legitimate, because the penalties and things are awful if you go down that route, and we certainly would never recommend that. But we can have a great, reduction in many of the taxes payable. That allows for, good intergenerational wealth transfer. And some of the key considerations are always the ongoing costs versus those tax payable. One of the other ones that is material we find in terms of making a decision, how deeply embedded you go. Do you set up an offshore trust, offshore companies, do looping structures, whatever it might be? What is around the investor's need to access any of that money? Many, wealthy people, they have offshore assets that'll be the last assets that they ever use, and they probably will never have to use them in their retirement and for the days that they've got to live off their capital in any sort of form. But that one, please, if you go into these structures and somewhere along the line, you've got to undo it all and pull money back to pay for your daughter's or son's wedding, for example. Guys, wrong decision. If you tie yourself up into the wrong structure, that will certainly be a silly sort of thing. So those are some of the other, other considerations. And final slide there, please, Peter. Okay. Be open-minded around your need to restructure and possibly pay some of that tax. That tax deferred principle, I think, is, illustrated with two simple examples, can be, put to bed in terms of being a bit of a myth in certain circumstances. And if you do make a decision to make the change, it's awful, because, if you look at some of the sort of things now, people are talking about in the last few weeks, sell up Naspers shares because they've come down and now move that money offshore. Once you make a decision on anything like that, don't hold on to what it could have been doing, or live with this regret, etc. You move forward because it's the right thing for your overall sort of investment strategy and plan. And once you make that move, just move forward on it. Please do your homework in that regard, and understand all the costs. Also understand the benefits. There are many benefits, and please, the fear does come into it, but I think it's ill-informed fear that sort of holds people back from pulling the trigger on what I do believe to be a universe of great opportunities that are out there. All right, so thank you, Peter. That is just a brief synopsis of how to look at weighing up some of the options. There are many more, and I'm sure some of them, the advisors out there do a great sort of some scenario plannings, a lot of illustrative examples, and good luck to everybody out there. It's, you will be excited with some of the opportunities that are out there for you. Thank you.
Thank you very much, Brendan. So hopefully, guys, it's given the participants of this webinar some more insight in terms of offshore investing and the mechanics of it. I think what's quite clear is that one needs to, get professional advice. We've had over 6, so I'm going to try and focus some specific ones, and perhaps the participants, if you want to just put your screens on there, so we can catch you out. Maybe something to pose to Brendan and or Darryl. So I haven't got money offshore. I've got a material investment in SA. Do I take money offshore now? And I think that simplest question is one that we have to answer almost on a daily basis. Do we wait or do we go? And what are the guiding principles? I think we've been through some of those, but Darryl, maybe you want to start with exactly how.
Yeah, okay. So the answer in short, Pete, is yes, you do start. You get a start as soon as possible, because for no other reason, the opportunity set in the offshore markets once you leave the South African shores is immense. However, it's easier said than done, and buying hard currency or making that initial step is an emotive thing for us South Africans, really. I don't want to pay 1 cent more for a dollar if I can avoid it, which often means that I'm waiting in this kind of, stuck in limbo trying to time the currency. I can assure you that in 5 years' time, you will not remember whether you paid 14 Rand 50 or 13 Rand 50 for your first dollar. But I can also assure you that the diversification that you would have given yourself by taking that first step in making an offshore investment would have been the right decision.
Okay, what's the most cost-effective way to take funds to the offshore account? What would you say is the minimum amount in SA rands that one should have to initiate this kind of investing?
Okay, so I'll take that one. There is no minimum, is the straight answer. However, there are some key considerations. One of those considerations is there's a relatively small 750 Rand fixed cost that's charged by the South African Reserve Bank to actually make exchanges into dollars. So just working off that figure, because everything else is a variable cost, naturally speaking, it does make sense to bulk up amounts of let's say 100,000 Rand or more when buying currency. A bigger consideration for me, though, is what am I doing with that money when I get overseas? The reality today is that it's going to cost you the equivalent of 50,000 Rand to buy one Amazon share when you get into the offshore markets. And so for smaller amounts of money, how do I create a level of diversification in what I'm investing in dollars? And so certain investments make sense for certain amounts of money, but working alongside your financial advisor to determine what that means is a key consideration. Long story short, there are products out there that cater for $1,000 investor, and there are products out there that cater for $1 million investor. It's time to get a start now, though, if you haven't.
Your opinion on a European joint account as a structure to hold your offshore assets?
So yes, you can do that. I think we just need to be a bit specific about which European country are we talking about, and to understand whether that joint account, because very often why one has a joint account is if one of you dies, the account can continue. And that's always quite specific to the particular jurisdiction. So that's the answer. Yes, you can. I think you've also just got to be a bit careful that whatever jurisdiction it is, that you get the estate duty rollover relief on death that applies between spouses. If I need to explain any more on that, please let me know, and I will. Those are the basic rules.
I think a lot of this stuff is quite technical, and a lot of the answers to many of the questions depends on your own specific situation. But we'll certainly try to give some blanket answers where applicable. So how does the tax residence liability to pay tax on international assets impact on the tax havens? Dar, do you understand that question? Do you want to give
Just repeat it, please.
How does the tax residence liability to pay tax on international assets impact on the taxless havens?
Taxless havens.
It's actually misspelled. So interpret that as you wish, Dar.
Thanks. So when you're talking about taxless havens, you're basically talking about those little circles that I mentioned. And the reason why you're there, and it depends which one you're in. Mauritius has certain taxes that apply. The Channel Islands don't have any taxes that apply. So what's more important is where you are tax resident and how it impacts whatever you're doing, how it impacts your tax residency. Those taxless jurisdictions are taxless. So I don't know if that helps you or not. Again, it's very case specific.
Thanks. A question from an old friend of ours, Mark Meehan. If one has arranged Portuguese tax domicile based on the lease of Portuguese property, but one has no Portuguese assets, is a Portuguese will required to deal with those worldwide assets or only Portuguese assets? Again, that's quite specific, but Dave, I don't know if you've got any.
Yeah, so we might have to come back on that. But basically, if you're tax domiciled in a country, one would assume that then the laws of that country would apply on your death, or the taxes in that country would apply on your death.
Thanks.
So
Brendan, a question.
Okay.
I'm just going to state there that I think wherever there's fixed property and you in a particular sort of country other than, when you're using investments and you're using wrappers or structures and there's beneficiary nominations, things are a bit different. But where you have fixed property, I would certainly say that 90% probability that you are going to need a proper will in that jurisdiction to be dealt with correctly. Okay, so
I think what Mike was saying there was that there's no property, it's just rental property. Is that right? Is that what the question said?
Yeah, so I think perhaps apply both. Yeah.
I think we can come back to you on that. It's a tricky jurisdiction because there is forced heirship in Portugal.
Yeah.
Brendan, one for you. Could you discuss other mechanisms to avoid citus tax? For example, keeping investments below thresholds, owning exempt assets, or via correct jurisdictions?
Yeah. So, I think the structures, for example, citus taxes themselves, or if you've got a correctly domiciled unit trust portfolio, that could easily, that'll be exempt from the citus tax. The US, they've got a threshold, I think, of 60,000 for the, I think it's at $60,000 US before citus tax would kick in, and I think the UK is £320,000, £25,000 or somewhere in that. So there are various sort of rules around it. But if citus tax largely applies, to sort of certain assets, be it, properties, individual, holding properties, physical properties, as well as the shares, which are domiciled in certain areas. So, those are the assets they look out for. Using structures and things like that are easy and very effective at getting rid of the citus problem.
Darryl, an easy one for you. If you invest in a local ETF or mutual fund, how is that viewed from a foreign investment perspective? And how do we view that versus taking the actual money offshore?
All right, so I assume you're referring to a local ETF or mutual fund that references an offshore portfolio, Pete? All right, so
the question, both.
Yeah, so
obviously to get offshore exposure, yeah.
Yeah, okay. So first prize, in our opinion, is get your money overseas. As individuals, get your money overseas via a single discretionary or foreign investment allowance. Asset swap being third prize, because when we're investing overseas, we want to know that our money has left the shores forever. Now, when you invest locally in an offshore fund, naturally that is done by an asset swap, or it's treated in the same way as done by an asset swap. So you have a local fund that remains a South African asset in the eyes of the South African Revenue Service and in the eyes of the South African Reserve Bank. And as I mentioned a little bit earlier, there are certain tax benefits to actually having money overseas in the calculation of capital gains. So first prize, get money overseas. But second prize, you get exactly the same exposure in rands by investing via a local ETF or mutual fund.
Okay, interesting one. What are the tax implications if you've got a joint offshore equity account in the US with your spouse, externalized and not in a wrapper, and one of you passes away? Does 50% of the portfolio go into the deceased estate? Again, all these questions are quite specific, but
yes, the answers. So the answer there is yes, and you don't get the rollover relief in your will in South Africa. if you leave your assets to your surviving spouse on death, you also take over their 3.5 million rand estate duty exemption. But if you have a joint account in the US, that rollover relief does not apply, and half of the assets will go into the deceased estate.
Okay, then the CGT implications of asset swaps. Could you perhaps give an example, Darryl? And I think the important part really there is...
I'm happy to give that example.
Yeah.
So, in the normal course of events, let's use 1.5 million rand that I want to buy $100,000 with, assuming the exchange rate is 15. If I take out my 1.5 million rand via foreign investment allowance and I buy $100,000, the calculated capital gain at the end of any tax year is effectively, let's say that the portfolio grows by 10%. My capital gain and the rand appreciates by 20% in the year. My capital gain responsibility, if I've taken it out directly and not via asset swap, is based on the $10,000 growth only. However, if I've taken it out via asset swap, the full capital invested is exposed to currency depreciation from a capital gains tax calculation. So, in other words, not just the $10,000 you've made, the capital depreciation on the 20% on the initial capital as well. I'm making it sound a lot more complicated than it is, but long story short, asset swap, you are fully exposed to currency depreciation against your original capital versus foreign investment allowance only on the dollar gain that you make.
If you made a 10% return in dollars, if you're taking it out, you're paying tax on CGT on 10%. If the rands depreciates about another 5%, you're paying tax on 15%.
Spot on.
That is what we're looking
More
at.
simple.
Darryl, maybe a wrapper question. Can more than a single owner own a wrapper? And would the wrapper continue for multiple owners? So if one of the multiple owners dies, how does that work?
It does. So we've had up to 4 owners, and there may be the ability to have more. So the answer to that question in short is yes. The wrapper lives. And even one of the additional benefits of the wrapper is you're able to nominate beneficiaries below the first layer of your contract holders. So in that example, say you've got husband and wife as your contract holders, something happens and they both pass away at the same time, the wrapper continues and passes into the hands of the nominated beneficiaries. So importantly here, you still pay South African estate duty on the value of your wrapper, but it doesn't get wound up in your estate. It passes seamlessly onto your beneficiaries the very next day, which is also why you save on the executive fees.
There's quite a few CITES questions here. CITES is a tax that we haven't seen applied, but we've certainly got some very strong messages from around the world that it will be. I think the more rigorous the jurisdiction, the more likely you are to face it. Holdings in the US are probably the most sensitive. We're going to see the examples from it. So a lot of good reasons. There's absolutely no point in taking that risk if you don't have to. But the 2 questions from a CITES point of view: which jurisdictions are CITES friendly for SA persons, and are UCITS ETFs exempt from CITES? So are ETFs viewed differently to shares? Dar, maybe you want to pick those up.
So I think it would depend where the ETF is registered is the most important thing to consider there. Darryl, you're nodding your head.
No, that's right, Dar. Spot on.
Okay, so that answers the one. And the next one?
And then what jurisdictions are CITES friendly, if that's a term that can be used for South African persons?
So they're lots. The answer is that they're lost, but the reality is it's where the asset is domiciled. So as an example, if you're buying Facebook shares, regardless of where your portfolio is anywhere around the world, CITES friendly or not, the original domicile of those Facebook shares is still the US. And so you may find friendly jurisdictions, but then you would also have to buy assets in those jurisdictions in order to benefit or to avoid CITES.
Sorry, Pete, the other thing there is if you would need to look at structures as well, because there are jurisdictions that are CITES friendly because you got a structure held in that jurisdiction. It's not in your own name.
I've been told that cash in a US broker account is also subject to citus tax. Is it different for money in the bank? And is that true? Do we have clarity on that? I think a lot of these things we don't have absolute clarity.
Yeah, I think we'd have to come back to you on that.
Cash amounts of money in the bank is not a citus asset though. So that's, and that's what Di's alluding to, is that it is a bit of a gray area, is that if that money was in the bank, it should fall outside of citus.
Then, in terms of all these fancy structures, what amount of money makes it worthwhile to transfer offshore in order to justify the cost of, say, a trust structure? Let's just give some basic materiality on,
Okay, so yeah, that's quite a difficult question, because it also would depend on whether there's a line of further funds coming into the structure. But basically, your offshore trusts, your fees per annum are anything between $5,000 to $10,000 a year. So it's whether that's justified. So we look at any amount of funds from $1 million to $2 million, but certainly nothing below $1 million. And even that, one hopes that there's a further line of funds coming into the offshore trust. But those costs we can certainly go through with you. We've worked with them extensively for years. We do understand how they work.
So again, lots of individual and quite specific questions here. Maybe to just go through a few. If one's investment is in an offshore wrapper, surely on death, SARS will calculate the value of your investment using the exchange rate at the time of death. So Darryl, I guess it would depend on how the money got there.
I don't disagree with that, absolutely. I think that when the calculation of your local estate, yes, that would be correct. Now, remember, of course, that the assumption, as is the case with any endowment wrapper, is that the wrapper provider is paying tax along the way for realizable events inside of the wrapper. But as part of your estate duty calculation, absolutely, you have a rand asset based on an exchange rate when you die.
But they will always look at what, they'll do the conversion to what the dollar value was when you took it out. Okay, it'll only be the capital gain in the dollar value, not the rand value, not the exchange. They'll treat it as an offshore asset rather than asset swap.
Yep.
A kind of general question from an anonymous attendee, whether you have a specific knowledge and expertise to advise on structure if somebody's contemplating a possible US immigration. So, how would we deal with somebody who...
So if you're going to the US, again, I'm sorry, I keep on banging on about it. It's very important to understand your specific circumstances. But yes, we do have expertise, but very often it's so complicated. We do refer it to people that we work with who are experts on the US. And we have in the past used a US tax attorney to give us advice on recommendation from one of the top legal firms here, because the knowledge that one needs is so specific. It also depends here, are the assets in your own name? Are they in trust? Do you have offshore trusts? All of that comes into it. When you move to the US, it's very complicated. If you're just going in your own name and there aren't too many assets here, I don't think it's really too much of a problem. The US estate duty amounts are much, much higher than ours. So all of that would need to be taken into account.
If the beneficiaries of an offshore investment are South African tax residents, would the money need to come back to South Africa, when they inherit? Or can they keep the money offshore? Do they need additional approvals to keep the money offshore? I think that's the question.
So if I'm understanding the question correctly, you're inheriting money offshore from a deceased estate. So no, you don't have to bring it back, but you do. It might have changed now with the change in legislation, but I think it was within 30 days, you've got to report it to the Reserve Bank and ask permission to keep it there. Particularly applies to property that you might inherit somewhere else. You have to inform the Reserve Bank.
Okay, folks, I think we've reached the end of our time limit. we were promising to end at about 3:15. So I think some very interesting questions. But what became obvious in the question session is everybody's got their own individual circumstances, intentions, and questions. So hopefully we've given you a nice umbrella overview. We've got expertise, experience, and we've dealt with lots of different people in different territories. And if you'd like to get hold of us, or your financial advisor deals with us, very happy to sit down and share our expertise. But it's clearly a very complex field, and the number of attendees today certainly confirms the huge interest in this segment of the market. The presentation will be circulated. There is a 4th episode of a 4-part series coming on in 2 weeks' time in terms of financial immigration. We'll be sending this presentation and slides out. And the first 2, which talk about the actual assets that you invest in offshore, and some exciting offshore shares, are available on our website under local research if you go to videos. So thank you very much for your time. Thank you very much for your interest. And we hope to continue being able to add value to you. Cheers.